So I want you to picture an old, weathered wooden utility pole for a second.
Oh, okay. Like the kind with all the rusty staples in it?
Yeah, exactly. Splintered wood covered in decades of lost dog posters. You know, a gray transformer just humming quietly up at the top.
Right. It's like the absolute definition of mundane infrastructure.
Totally. I mean, it's been standing on that corner for 50 years, and it'll probably be there for 50 more.
It's the ultimate background object. Like, society really only notices the physical grid when the power goes out or, when the monthly bill arrives.
Right. Invisible infrastructure. But now I want you to pull up a completely different image in your mind.
Okay, I'm ready.
Picture a hyperscale artificial intelligence data center. We are talking millions of square feet.
Oh, wow. Yeah.
Just endless rows of glowing server racks, advanced liquid cooling systems pumping fluorinated fluids, billions of parameters being calculated every single microsecond.
So you're contrasting the slowest, most heavily regulated sector in the global economy with basically the fastest moving arms race in the history of tech.
Exactly. The rocket ship versus the dirt. But here's the dynamic we're unpacking today for you, the retail investor.
Because those two completely disparate images, they're currently crashing into each other at 100 miles an hour.
All right. Welcome to this deep dive into FirstEnergy Corp's second quarter 2026 earnings call. FirstEnergy trades under the ticker symbol FE.
And today we've got our talk tickers hats pulled down tight.
You know it. Our mission here is to cut straight through the corporate jargon, extract the absolute most critical data from the call, and figure out exactly what this means for your portfolio.
We are breaking down the headline numbers, mapping out the whole story behind them, taking a hard stance, and delivering actionable takeaways.
Because the tension in this specific earnings call is just unlike anything we typically see in the utility space.
Oh, it really is. I mean, for decades, the utility sector has been this sleepy, slow-growth corner of the stock market. The classic widow and orphan stocks, right?
Exactly. You buy them for the reliable dividend yield, you stick them in a retirement account, and you just accept that they will never, ever offer hyper-growth upside.
But then, you read this Q2 transcript, and suddenly that sleepy utility company is sitting on a massive, rapid growth AI tailwind.
It's wild. A company that literally just bills people for keeping the lights on in Ohio and West Virginia has suddenly become this critical bottleneck for artificial intelligence infrastructure.
Oh, right. How does that even happen?
Well, let's get right into the headline numbers.
Yeah, because before we can analyze the AI rocket ship, we really have to audit the launch pad.
Perfectly said. So the raw data from the quarter gives us a very clear picture of that launch pad.
Give it to me.
For the second quarter of 2026, FirstEnergy reported GAAP earnings per share of 50 cents.
Okay, and that's up from 46 cents in the second quarter of 2025, right?
Correct. But alongside that, they reported Q2 core EPS of 50 cents, which is actually slightly down from the 52 cents they posted a year ago. Okay, so GAAP is up, but core is down 2 cents.
Yeah.
Now, for the Talk Tickers audience, I mean, we don't need to rehash the basic definition of core versus GAAP.
No, they know it.
You all know core strips out the one-time accounting anomalies to show the, operational run rate of the business.
Right, the real engine.
But what we need to understand is the actual mechanics of that 2-cent drop. Because on a surface level, an earnings drop is an immediate red flag.
Oh, absolutely. The market routinely punishes companies for going backward year over year.
But reading through the transcript, I noticed management didn't seem to be playing defense on this at all.
Not even a little bit. Now, John Somerhalder, who took the lead on the call, he preempted any panic by detailing exactly what drove that 2-cent variance.
And it wasn't a bad thing.
No, this wasn't a case of lost revenue or shrinking margins. It was a totally planned, forecasted shift in the timing of operations and maintenance.
O&M expenses, right?
Exactly.
Yeah.
Specifically, they pulled forward several really heavy maintenance projects into the shoulder months of Q2.
Okay, what kind of projects are we talking about here?
We are talking about aggressive tree trimming schedules along their transmission corridors and also taking baseload generation plants offline for planned maintenance.
Ah, so they're doing the dirty work before the intense summer peak hits in July and August.
Precisely. They spent the money in Q2 to ensure the grid just wouldn't buckle in Q3.
That makes total sense.
And they communicated this exact trajectory on their Q1 call too. They warned analysts that Q2 would look slightly lighter on a year-over-year basis because of these proactive grid hardening expenses.
So there was no surprise there.
None at all. And if you zoom out and look at the first 6 months of the year cumulatively, Their core EPS sits at $1.22.
Which is a solid beat compared to the $1.19 they logged for the same period a year ago.
Right. The broader growth trend is perfectly intact.
Okay, so let's look at the profitability metric that actually matters for a utility.
The ROE.
Right, their consolidated return on equity, which came in at 9.5%. Now, people often look at ROE for a tech company and they think about pricing power or like software margins.
Right. But a regulated utility's ROE operates completely differently.
Yeah, I like to think of it less like a free market profit margin and more like a government-backed toll road.
That is the foundational concept of utility finance, right?
Yeah.
The toll road mechanism.
Let's break that down for the listener.
Sure. So in a normal business, you increase profits by selling more product or just raising prices.
Right.
But a regulated utility operates as a regional monopoly. So the government steps in to protect consumers.
The Public Utility Commission, right, the PUC.
Exactly. The PUC tells the utility, look, you cannot charge whatever you want.
Okay.
However, if you invest your own capital up front to build the physical lanes of this toll road, like the substations, the transmission lines, the transformers.
Right, putting steel in the ground.
Yeah. If you do that, we will legally guarantee you a specific percentage cut of the revenue collected from ratepayers.
So you put the money in the ground, and the government hands you this legally binding contract guaranteeing you, in this case, a 9.5% return on that specific pile of money.
For like the next 30 years.
That is wild. That 9.5% is literally the toll rate.
Exactly. So when management reports a 9.5% consolidated ROE, they are sending a very specific signal to the market.
Which is what?
They're proving they can successfully manage their internal costs, navigate the really complex regulatory filings across multiple states, and actually achieve the maximum profit margin the government allows them to make.
So hitting that target means the core machinery of the business is operating flawlessly.
Exactly. The baseline is solid.
The toll road is collecting the tolls exactly as modeled.
Yep. Boring but beautiful.
Okay, so let's move from that baseline into the active drivers of the business. Like, what is actually moving the needle this quarter?
Well, the primary engine is their formula rate investment program.
Okay, meaning what?
Meaning they are deploying capital into grid modernization, which translates directly into that rate-based growth we just talked about.
Oh, got it.
We'll dissect the mechanics of that capital deployment in a second, but it's worth noting those returns were slightly offset this quarter by the higher O&M expenses we just covered.
Sure. But the metric that jumped completely off the page for me in this section was the load data.
Oh, absolutely.
Just for context, in utility parlance, load is the aggregate volume of electricity actively being drawn by customers.
Right. It's the total demand on the system.
So total customer load increased by approximately 2% on a weather-adjusted basis.
And in the context of a mature, like heavily saturated utility market, a 2% baseline increase across a massive geographic footprint is just highly abnormal.
Really? Why is that so unusual?
Because for the last 10 to 15 years, utility load growth in the United States has been essentially flat, sometimes even negative.
Wait, really? Even with population growth?
Yeah, mostly because of energy efficiency.
Oh, right. The transition to LED light bulbs, better insulation, all that.
Exactly. Highly efficient HVAC systems basically wiped out any natural demand growth from population increases.
So the prevailing thesis on Wall Street for a decade was that electricity demand had basically decoupled from economic growth.
Yeah, that was the accepted wisdom. But this 2% figure shows that decoupling is over. The grid is waking up.
And when you look past that blended 2% average, the internal dynamics are staggering.
Let's hear it.
Residential load is relatively stable, right? But industrial load was the absolute breakout star.
Oh, huge. Industrial demand increased over 4%.
Which is massive. And management specifically highlighted the subsectors driving this pull on the grid. They said metals, oil and gas, and chemicals.
Right. And here's where I have to stop and connect these dots because this is the first breadcrumb leading to the AI story.
Okay, lay it out.
If I tell a casual investor that a company has massive AI tailwinds, their mind immediately goes to software.
Right. They picture a tech giant buying thousands of NVIDIA GPUs and writing algorithms.
Exactly. So they ask, how on earth does building a large language model increase the physical demand for steel manufacturing and chemical processing in Ohio and Pennsylvania?
Yeah, how does it?
Right.
Because that sounds totally disconnected.
You have to look at the physical supply chain that makes the digital cloud possible.
Okay.
The cloud is not ethereal, it is aggressively physical. It lives inside hyperscale data centers that cover millions of square feet.
Right, these massive, massive buildings.
And before a tech company can ever plug in a GPU to train an AI model, a massive industrial supply chain has to physically build the facility.
Oh, I see. And that supply chain is incredibly energy intensive.
Exactly. You need thousands of tons of structural steel just to build the framing and the reinforced server racks.
Okay.
You need miles of highly refined copper wire for the internal power distribution. You need massive industrial HVAC units.
And didn't they mention the next generation AI chips run incredibly hot?
Yes, which means you need highly specialized liquid cooling systems.
Which requires chemicals.
Exactly. Those systems require the production of complex fluorinated fluids and advanced refrigerants.
So, and let me make sure I'm getting this, the factories manufacturing that steel, smelting that copper, and synthesizing those chemicals are located squarely inside FirstEnergy's service territory.
Right there in the Rust Belt and the Ohio River Valley.
Wow. So FirstEnergy is essentially double dipping on the AI revolution.
100%. They are experiencing a massive surge in electricity demand from the legacy industrial base that's manufacturing the physical components of the data centers.
They are powering the factories, making the picks and shovels long before they even connect a power line to the actual data center itself.
It is the ultimate derivative play.
That is so fascinating. Which brings us to how FirstEnergy is actually responding to this surge in demand.
Right, the capital deployment.
Yeah. In the first half of the year, FirstEnergy deployed $2.9 billion in capital. That represents a 19% increase compared to their capital deployment in the first half of 2025.
And a 19% acceleration in capital expenditure is a massive financial pivot.
Okay, I am going to aggressively push back on this on behalf of our Talk Tickers audience.
Bring it on.
Because we need to clear up a massive cognitive dissonance here.
What's the issue?
If we were analyzing literally any other sector in the market, say a semiconductor manufacturer, a retail chain, an airline,
right,
and the CEO got on the earnings call and proudly announced, hey, great news, everyone. Our capital spending just surged 19% year over year to nearly $3 billion.
The stock would crater?
It would crater. Analysts would downgrade them instantly. A massive sudden spike in expenses usually signals bloated management, margin compression, or just a desperate attempt to buy market share.
Totally true for a normal company.
So why on earth is a 19% jump in spending considered a bullish signal for a utility?
Because utility accounting flips traditional financial analysis completely upside down.
Okay, explain that.
You had to separate operating expenses, like paying employee salaries or buying fuel, from capital expenditures.
Right.
For a regulated utility, capital deployment is not lost cash dragging down the bottom line. Capital deployment is the sole mechanism for rate-based growth.
Going back to our toll road analogy, let's walk through the actual mechanics of how spending $1 today turns into guaranteed profit tomorrow.
Sure. So let's say FirstEnergy needs to build a new high-voltage transmission substation to support this surging industrial demand, right?
Okay.
They spend $100 million in capital to build it. They don't expense that $100 million on this year's income statement.
So where does it go?
Instead, they capitalize it. They add that physical substation to their balance sheet as an asset. That asset becomes part of their rate base.
Which is the total value of the toll road.
Exactly. Then FirstEnergy goes to the State Utility Commission and says, look, we just invested $100 million into the grid to improve reliability and support manufacturing.
Right.
We request permission to earn our approved 9.5% return on this new asset.
And the regulators just agree.
They audit the project, agree it was necessary, and adjust the rates charged to customers.
Wow.
So FirstEnergy is now legally authorized to collect enough revenue to cover the depreciation of that substation, pay the taxes on it, and extract a guaranteed $9.5 million in pure profit every single year for the multi-decade lifespan of that asset.
Okay, wait. So they are essentially taking $3 billion in cash, burying it in the ground in the form of copper wire and steel transformers, and transforming it into a legally binding annuity that prints a 9.5% yield for the next 40 years.
That is exactly what they are doing.
That is incredible.
So a 19% increase in capital deployment means they are aggressively expanding the total surface area of their guaranteed returns.
Right. Wall Street cheers for utility CapEx because it provides mathematical certainty regarding future earnings growth, provided the regulators continue to approve the investment.
Exactly. It's a completely different rule book.
So let's summarize where we are. The base business is humming. The industrial sector is ramping up to supply the AI infrastructure boom. And FirstEnergy is shoveling capital into the grid to legally lock in future profits.
It sets the stage perfectly.
It really does. It sets the stage for what I can only describe as the holy smokes moment of this earnings call.
Oh, yeah. The guidance.
Let's dive right into the management guidance.
So management started this segment of the call by reaffirming the steady baseline.
Okay.
They reiterated their 2026 core earnings guidance range of $2.62 to $2.82 per share.
Solid.
They reaffirmed their long-term pledge to deliver 6 to 8% annualized earnings growth through 2030. And they locked in their commitment to a massive $36 billion 5-year capital investment plan.
Okay, so the toll road metrics remain perfectly stable.
Yes. But then the tone of the call shifted entirely to the true catalyst.
The data centers.
The data centers.
Yeah.
The figures they dropped regarding future load demand are bordering on the surreal.
I mean, across their entire multi-state system, the total forecasted pipeline for data center power demand increased by 30%.
Which is wild.
And that's just since the first quarter. In a matter of 90 days, the pipeline swelled by 30%, reaching an aggregate forecasted demand of 25 gigawatts.
And we really must emphasize here, this is not just a collection of vague inquiries or exploratory phone calls from tech companies.
Right. These aren't just tire kickers.
No, these are hard negotiations. During the second quarter alone, FirstEnergy officially contracted an additional 2.1 gigawatts of capacity.
Oh.
That brings their total legally contracted data center demand to 6.4 gigawatts.
That's massive.
And furthermore, management explicitly noted they expect to sign contracts for another 1.5 gigawatts in the, quote, next couple of weeks.
The velocity of these deals is staggering.
It really is.
We need to pause and establish scale here, though, because the term gigawatt often just washes over people.
Oh, absolutely. Unless you're an electrical engineer, it sounds totally abstract.
Right. You think of Doc Brown in Back to the Future frantically trying to generate 1 gigawatts of power to send a DeLorean through time.
Right, exactly.
What does 25 gigawatts actually look like in the real world?
Okay, so 1 gigawatt of power is roughly equivalent to the generation capacity of 2 average-sized nuclear reactors.
Wow. 2 nuclear reactors for 1 gigawatt.
Yeah, or enough electricity to power about 750,000 average American homes continuously.
Okay, let me do the math. So 25 gigawatts is enough power for nearly 19 million homes.
Correct. But the single most staggering statistic of this entire earnings call, the one that truly illustrates the sheer gravity of this AI tailwind, is the comparison to their existing grid.
Lay it on me.
That 25 gigawatt pipeline of future data center demand now represents approximately 70% of FirstEnergy's entire July system peak load.
70%.
Yes. Sit with the physical reality of that metric.
Let me just map that out for a second. Take every single residential customer. FirstEnergy serves across Ohio, Pennsylvania, West Virginia, Maryland, and New Jersey.
Okay.
Add in every hospital, every school, every massive steel mill, every office building, running their air conditioning at maximum capacity on the single hottest day of the summer.
The absolute peak.
Their absolute peak system load for all of that was 34.8 gigawatts.
Yep.
Now, a handful of hyperscale tech companies are knocking on their door, asking them to find an additional 25 gigawatts just to power server racks.
It's insane.
They're essentially being asked to build a second parallel utility company from scratch solely to sustain the artificial intelligence industry.
When you grasp the sheer physics of that demand, you really begin to understand the absolute frenzy currently gripping the energy markets.
That's a gold rush.
It is, because training a massive AI model like GPT-4 or whatever iterations are coming next requires an astonishing density of electricity.
Right.
These GPUs run at maximum capacity, 24/7, for months at a time during a training run. You cannot power that with intermittent resources, and you physically cannot plug a facility of that magnitude into a standard industrial park grid.
Right, because the hyperscalers, Microsoft, Amazon, Google, Meta, they are sitting on hundreds of billions of dollars in cash.
Money is not their constraint.
Exactly. They are in an existential arms race to achieve artificial general intelligence. Time and electricity are their constraints. They need immense amounts of baseload power, and they need it yesterday.
And management provided the math on exactly what it takes to connect these behemoths to the grid.
Oh, this is the best part.
They stated that on average, it requires roughly $250 million in capital investment for every single gigawatt of transmission capacity added to serve a data center.
Okay, let's explore the mechanics of that 250 million. Like, what are they actually buying? You don't just run a bigger extension cord to the building.
Definitely not. You are building entirely new, bespoke, high-voltage infrastructure. You have to construct massive new substations right next to the data center footprint. You need highly specialized step-down transformers, which, by the way, currently have global supply chain backlogs stretching 2 to 3 years.
Wow, really?
Yeah. You need massive switchgears, heavy-duty breakers, and miles of reinforced high-voltage transmission lines to connect the new substation back to the main generation arteries.
So it's heavy, highly engineered, incredibly expensive physical infrastructure.
Exactly.
So let's run the math on the pipeline. If you take that 25 gigawatt pipeline and apply the management metric of $250 million in infrastructure investment per gigawatt, you are looking at a potential pipeline of $6.5 billion in new capital investment.
And going back to our breakdown of utility finance, that is a potential $6.25 billion expansion of their rate base.
Unbelievable.
That is $6.25 billion of fresh capital that they can bury in the ground and legally extract a guaranteed return on for the next 3 to 4 decades.
It is a generational financial opportunity.
Truly.
But, a skeptical retail investor should be asking a very pointed question right now.
Which is?
Why FirstEnergy? There are dozens of major utility companies in the United States. Why are all the hyperscalers swarming this specific company in the Mid-Atlantic and Rust Belt?
It's a great question. And the earnings call highlighted a massive, virtually impenetrable competitive moat for FirstEnergy.
Okay, what is it?
It boils down to a confluence of geography and regulation. Let's tackle geography first, because FirstEnergy's service territory sits directly astride the most critical internet choke point on the planet.
The famous data center alley in Northern Virginia.
Exactly. For historical reasons dating back to the early days of the internet, when AOL set up its headquarters and the federal government laid massive fiber optic trunks.
Right.
Ashburn, Virginia became the absolute center of gravity for global web traffic. An estimated 70% of the world's internet traffic passes through Loudoun County, Virginia.
Which is crazy to think about.
So naturally, every tech company built their data centers there to reduce latency.
But Ashburn is completely gridlocked now, isn't it?
It is entirely full.
Okay.
They have exhausted the available land, and more importantly, the local utility, Dominion Energy, has explicitly warned that the regional transmission grid is tapped out.
Wow.
They physically cannot import enough electrons into Loudoun County to satisfy the pending data center applications. The grid is at its thermal limit.
So the tech companies have no choice. They have to migrate.
Exactly. And on the western flank of FirstEnergy's territory, you have the booming tech hub in New Albany, Ohio.
Right, where Intel is building those massive semiconductor fabs and Google and AWS are rapidly expanding.
Right. And FirstEnergy's transmission footprint sits directly between these two epicenters. They cover Maryland, West Virginia, Pennsylvania, and Ohio.
I see.
So as the Northern Virginia hub desperately expands westward, hunting for available power, and the New Albany hub expands eastward, they are both bleeding directly into FirstEnergy's transmission network.
So FirstEnergy controls the land bridge. They are standing in the only geographical path these tech giants can take to achieve their necessary scale.
Location is an incredible advantage.
It sure is. But the second part of their moat is arguably even more powerful, right? And it hinges on the arcane mechanics of power market regulation.
Specifically in the state of West Virginia.
Okay, walk us through this.
This is the critical regulatory nuance that separates FirstEnergy from almost every other utility trying to play the AI boom.
Okay.
The United States power grid is not a single unified system. It is a fragmented patchwork of different state and federal rules.
Right.
Over the last 30 years, many states chose to deregulate their power markets.
Explain the mechanics of a deregulated state for a hyperscaler trying to build a data center. Like, what do they actually have to do?
In a deregulated state, like Ohio or Pennsylvania, the company that owns the power plant generating the electricity is legally separated from the company that owns the transmission lines delivering the electricity.
Yeah.
So if you are Amazon and you want to build a gigawatt data center in a deregulated state, you have to run a gauntlet. First, You have to negotiate a massive power purchase agreement with a merchant generation company to secure the actual electron.
Right, you got to buy the power.
Then you have to negotiate with a local transmission utility to figure out how to physically deliver that power to your facility.
And then you hit the dreaded interconnection queue.
Yes, you have to apply to the regional grid operator, like PJM interconnection, just to get permission to plug your facility into the larger grid.
Which is not fast.
Not at all. PJM has to run massive multi-year engineering studies to ensure your gigawatt of demand won't destabilize the entire regional network.
How long does that take?
That interconnection queue currently has a backlog of 3 to 4 years just to get a study completed, let alone begin construction.
Wow.
It is incredibly slow, intensely bureaucratic, and deeply fragmented.
But West Virginia operates under a completely different paradigm.
Because West Virginia never deregulated. It is a traditional, vertically integrated, regulated state. FirstEnergy operates there as an absolute one-stop shop.
So they do it all.
They own the high-voltage transmission lines, they own the local distribution network, and they are legally permitted to own and build the massive baseload power plants.
Okay, so the mechanics of that are a game changer for AI.
Huge.
Because if a hyperscaler comes to FirstEnergy in West Virginia and says, hey, we need 1 gigawatt of continuous baseload power online in 3 years,
right.
FirstEnergy doesn't have to point them to a multi-year grid operator queue. FirstEnergy can look them in the eye and say, excellent, we will handle the engineering.
We will build the natural gas plant to generate the gigawatt, and we will build the dedicated transmission line to deliver it directly to your servers.
Sign 1 contract with us, and we will handle the rest.
And speed to market is the single most valuable currency in the AI arms race right now.
Because these tech companies are locked in a $1 trillion battle for dominance.
Exactly. Waiting 4 years to navigate a deregulated interconnection queue could mean missing a product cycle and losing the market entirely.
Yeah, they will gladly pay a premium for the streamlined one-stop shop execution that West Virginia provides.
And FirstEnergy is aggressively capitalizing on this exact regulatory arbitrage.
They mentioned a specific project on the call, right?
Yes. On the call, management highlighted a highly specific, massive project. The 1.2 gigawatt Maidsville Energy Center they are pushing to build in West Virginia.
The Maidsville project is kind of the ultimate litmus test for this entire thesis.
It really is. Building a brand new 1.2 gigawatt baseload power plant is a monumental undertaking.
Yeah.
They are currently navigating the CPCN process with the West Virginia Public Service Commission.
Let's break down that acronym. What is the CPCN and how does the mechanism work?
CPCN stands for Certificate of Public Convenience and Necessity.
Okay.
Even in a vertically integrated state, a utility cannot simply decide to build a billion-dollar power plant and force the ratepayers to foot the bill.
Right, that would be crazy.
They have to formally petition the state regulators and mathematically prove 2 things.
Which are?
First, that the new power generation is absolutely necessary for the stability and economic growth of the region. Second, that the financial structure of the plant will not unfairly burden existing residential customers with massive rate hikes.
Okay, I'm going to throw a massive wrench into this thesis right here.
Okay, what is it?
Because as an investor, you have to look at the macro trends. Maidsville is expected to be a massive natural gas-fired plant.
Correct.
And there is heavy speculation that it will operate in tandem with, or at least heavily rely on, existing coal dynamics in West Virginia, a state historically dominated by the coal industry.
Right.
So wait a second. For the last 10 years, the entire narrative of the utility sector, largely driven by massive pressure from ESG-focused institutional investors like BlackRock and Vanguard, has been about the energy transition.
Yes, it has.
The mandate was simple: retire coal, phase out natural gas, and replace everything with intermittent wind and solar. So how on earth is FirstEnergy going to get away with building a massive new fossil fuel plant without triggering a revolt from Wall Street? Aren't they terrified of creating a stranded asset?
That is the exact friction point where the AI revolution is violently colliding with the ESG narrative.
And who is winning?
AI is winning. Management's response to this dynamic on the call was incredibly telling.
What did they say?
They didn't apologize for the fossil fuels. They explicitly stated this plant isn't going to replace the coal plants that we currently have operating in the state. It's going to be added to them.
Wow.
They said, we do not need to be retiring plants right now. We need to be actively adding baseload plants.
So they're essentially saying the energy transition is paused because the AI demand is just too overwhelming.
The physics of the situation leave them no choice. You physically cannot power a hyperscale AI data center with intermittent wind and solar alone.
Why not? I mean, battery storage is getting better, right?
Sure, but if a cloud sweeps over a solar farm or the wind dies down for an hour, you cannot let the power drop at a data center. Right. If the servers lose power mid-calculation during a 3-month LLM training run, you corrupt the entire data set and lose tens of millions of dollars in compute time.
Oh, man. I didn't even think about that.
They require 99.99% uptime, 24 hours a day, 7 days a week. The only technologies capable of providing that scale of reliable baseload power are nuclear, coal, and natural gas.
And since building a new nuclear plant takes 15 years and $20 billion, natural gas is really the only bridge available today.
Exactly. And Wall Street's tone has completely shifted in the last 12 months.
Interesting.
The major institutional funds realize that if they want the massive returns from their investments in Microsoft, NVIDIA, and Google, they have to allow the utilities to build the natural gas plants required to run the chips.
That makes total sense. It's a trade-off.
Furthermore, management noted that the political establishment in West Virginia fully understands this leverage. The state views highly reliable, vertically integrated energy as their ultimate economic development weapon.
Because it attracts the tech companies.
If the regulators approve the Maidsville plant, it paves the way for billions of dollars in tech infrastructure investment and thousands of high-paying jobs flowing directly into West Virginia.
Pulling capital away from neighboring deregulated states?
Exactly. It creates a reproducible blueprint.
And management was remarkably forward-looking on the call about this.
They were. They explicitly stated they view Maidsville not as a one-off project, but as just the absolute beginning of a much broader generation investment cycle in West Virginia.
The mechanics of this are wild. Like, they are already drafting requests for proposals, RFPs, to secure the heavy equipment and turbines needed for the next massive baseload generation plant.
Before the Maidsville plant is even fully approved by the state.
Right. They're adopting the aggressive, hyper-fast development cycles of the tech industry and just completely abandoning the slow, methodical pacing traditional to utilities.
And they are exploring highly creative corporate and regulatory structures to accelerate that execution even further.
Like where?
Well, on the call, management mentioned the potential of establishing a GNCO, a standalone generation company's subsidiary.
Okay, walk us through the mechanics of a GNCO. Why spin up a separate subsidiary just to build a power plant?
It comes down to jurisdiction and the Commerce Clause. State public utility commissions only have jurisdiction over retail electricity sales within their state borders.
Right.
But if FirstEnergy sets up a standalone GNCO, that entity can enter into massive, long-term, wholesale power purchase agreements directly with the tech giants.
Oh, I see where this is going.
Wholesale power transactions that cross state lines, say generating power in West Virginia and selling it wholesale to a data center operator managing a portfolio across the PJM footprint.
Yeah.
Those transactions fall under the jurisdiction of FERC, the Federal Energy Regulatory Commission.
Ah. So they are essentially trying to elevate the regulatory approval process out of the local state politics and up to the federal level.
Exactly, where the mandate for grid reliability and interstate commerce might provide a faster, more streamlined path to getting steel in the ground.
It is a brilliant regulatory arbitrage strategy.
The entire focus of the executive suite right now is captured in a phrase they used on the call: speed to power.
Speed to power.
They know the demand is virtually infinite. The only variable that matters is how fast they can navigate the regulatory maze and physically construct the infrastructure.
Speed to power. That is the defining rhetoric of this entire era of utility investing.
It really is.
So we have audited the foundational numbers, we have tracked the industrial loads surging from the AI supply chain, we have quantified the sheer mass of a 25 gigawatt data center pipeline.
And we've unpacked the aggressive regulatory strategies FirstEnergy is deploying to capture this growth.
Which brings us to the most critical part of the deep dive, Section 4, the bottom line. What are the actionable takeaways for the retail investor listening to this breakdown?
Well, the core philosophy of Talk Tickers is that we don't just summarize data, we synthesize it and take a definitive stance. Based on the mechanics we've unpacked from this Q2 2026 earnings call, we are establishing a strongly bullish stance on FirstEnergy stock.
Strongly bullish. Let's build the case for why.
Okay.
As an investor, you are constantly trying to balance risk against potential reward. Right now, if you want exposure to the AI boom, you have to buy high-flying tech stocks or semiconductor manufacturers trading at 50, 60, sometimes 80 times forward earnings.
Right. You are paying a massive premium.
And you are taking on extreme volatility risk if the AI hype cycle cools down for even a quarter.
But FirstEnergy offers a completely asymmetrical risk profile. You are buying a company that provides the single most critical bottleneck to the entire AI revolution, which is physical power generation and transmission.
Right.
But you are buying it wrapped in the defensive, boring shell of a regulated utility stock. You are acquiring hypergrowth optionality, but your downside is protected by a legally guaranteed 9.5% return on equity and a highly reliable dividend yield.
So, mechanically, what does this mean for your portfolio management? If you are currently holding FirstEnergy stock in your account, the data from this quarter suggests you firmly hold your position.
If you already own the shares, you sit back and collect the dividend. You allow the existing $36 billion base capital plan to grind out steady, high single-digit earnings growth.
Yep.
And you treat the 25 gigawatt data center pipeline as massive embedded call options that will slowly materialize on the balance sheet over the next 3 to 5 years as contracts are signed and steel goes into the ground.
But what if you were sitting on the sidelines? What if you were listening to this deep dive and considering allocating new capital to initiate a position in FE?
You never want to buy blindly. You need a trigger.
Right. What's the trigger?
If you are looking for an entry point, there is a highly specific near-term mechanical catalyst you need to monitor closely. On the call, management stated outright that if the CPCN for the Maidsville plant is approved by West Virginia regulators, they will be forced to formally update and increase their long-term capital expenditure guidance later this year or early next year.
Let me translate the mechanics of that statement for everyone.
Go for it.
Remember our breakdown of how utilities convert CapEx into guaranteed profit?
The toll road.
Right. Management is explicitly telegraphing that their current publicly stated financial projections, that massive $36 billion spending plan, and the 6 to 8% earnings growth rate that Wall Street is currently using to price the stock are likely conservative.
Exactly. The current stock price reflects the existing 5-year plan.
Right.
If the state of West Virginia hands them the permit for Maidsville, FirstEnergy will announce a multi-billion-dollar upward revision to their capital spending plan.
And in the utility sector, a massive upward revision in approved CapEx is a mathematical guarantee of future earnings upgrades.
When the analysts adjust their models to reflect that larger rate base, it serves as a massive, tangible catalyst for stock price appreciation.
So you really want to set alerts for any regulatory news coming out of the West Virginia Public Service Commission this fall.
Absolutely. That is the key.
So that is the bull case, perfectly articulated. But our mandate is to provide a complete, unbiased analysis.
Always.
We have to invert the thesis and hunt for the hidden traps. What are the mechanical risks? What specific friction points could derail this bullish trajectory and crush the stock?
Well, the primary existential risk for any regulated utility is regulatory friction. The government gives you the monopoly, but the government can also squeeze your margins if the political winds shift.
Right. We just spent 20 minutes praising the vertically integrated pro-development environment in West Virginia.
But FirstEnergy is a massive holding company that operates across multiple states, and not all of them are friendly.
Right.
The most acute risk right now is that in the third quarter, they are filing major base rate cases in both New Jersey and Maryland.
Okay. Let's explain the mechanics of a base rate case, because it is essentially a high-stakes political trial.
It really is.
A rate case is when the utility formally petitions the state government, saying, hey, we have invested massive amounts of capital into the grid over the last few years.
Right.
Now we are legally requesting permission to raise our customers' monthly electricity bills to recover those costs and earn our authorized return.
And as you can imagine, in a period of high inflation, politicians and consumer advocacy groups absolutely despise it when power bills go up.
Oh, they fight it tooth and nail. It becomes a highly combative, hyper-political environment.
And New Jersey in particular is a notoriously tricky regulatory arena.
I can imagine.
During the Q&A portion of the earnings call, an analyst zeroed in on this exact vulnerability.
Boy, did they ask.
They pressed management on the risk of the New Jersey Board of Public Utilities aggressively pushing back on FirstEnergy's capital recovery, or worse, attempting to artificially lower their allowed return on equity to appease voters.
Wow, just changing the rules of the game.
Yeah. The analysts specifically cited a recent executive order issued by the New Jersey governor's office that mandated an intense focus on energy affordability and reducing the burden on ratepayers.
So you have a governor essentially ordering the regulators to keep utility bills down right before an election cycle, and FirstEnergy is walking in asking for a rate hike.
It's tough timing.
That is a massive mechanical risk. How did management defend their position against that political headwind? Because you can't just walk in and demand money. You have to prove you earned it.
Management defended their position by bringing unassailable mathematical receipts. They didn't rely on rhetoric. They relied on engineering data.
Oh, nice.
Management reminded the analysts that during their last grueling rate case in New Jersey, the regulators essentially gave them an ultimatum.
What was it?
The regulators demanded that FirstEnergy invest heavily in targeted grid reliability, specifically ordering them to fix the absolute worst performing electrical circuits in the state.
The politicians essentially said, if you want us to approve future returns, you have to stop the blackouts in these specific neighborhoods.
Exactly. FirstEnergy took the mandate, deployed the capital exactly where they were told, and executed the engineering upgrades.
And did it work?
The data they presented on the call is their ultimate shield against political pushback. They improved grid reliability in New Jersey by a staggering 38% year to date.
38%. Let's contextualize that, though. How is that actually measured mechanically?
Utilities measure reliability using two primary metrics, SAIFI and SAID.
Okay, what do those stand for?
System Average Interruption Frequency Index, which measures how often the power goes out, and System Average Interruption Duration Index, which measures how long the power stays out when it does fail.
Okay.
By upgrading substations, installing automated smart switches that can reroute power around a downed tree instantly, and hardening the physical poles, FirstEnergy drove those outage metrics down by nearly 40%.
That is a massive, tangible quality of life benefit to the voters of New Jersey. I mean, fewer ruined groceries and warm refrigerators, fewer businesses shutting down for the afternoon.
Exactly. So when FirstEnergy executives walk into the regulator's office this quarter to litigate their rate case, they aren't just asking for a handout.
Right.
They're going to slide a piece of paper across the desk, proving they achieved exactly what the politicians demanded of them. That data transforms a highly emotional political fight over utility bills into a cold, hard math equation.
It's the ultimate proof of execution. FirstEnergy fulfilled their end of the regulatory bargain. They provided the essential service the communities demanded.
Yes.
Mechanically, that makes it incredibly difficult and honestly legally perilous for the state regulators to deny them the recovery of those specific costs.
Because if regulators refuse to pay a utility after the utility successfully completes a mandated grid upgrade, the utility can appeal to the courts, and it destroys the state's ability to attract future infrastructure investment.
Absolutely. It demonstrates that this specific management team possesses the most critical skill required to run a multi-state utility. They know exactly how to play the complex, localized political and regulatory games across different jurisdictions.
Right. They leverage aggressive textile expansion in friendly states like West Virginia, while executing defensive, highly targeted reliability engineering to secure their capital recovery in hostile states like New Jersey.
It's super smart.
Very.
Well, we have covered a massive amount of technical and financial ground today on Talk Tickers.
We really have.
We've translated the accounting mechanics behind the gap numbers. We've uncovered the physical AI supply chain driving the industrial load surge.
We've mapped the sheer physics and capital requirements of a 25 gigawatt data center tidal wave.
Yep, we've explored the geographical and regulatory moats protecting FirstEnergy, and we've analyzed the exact legislative catalysts and rate case friction points you need to monitor.
Synthesizing all of this data fundamentally alters how we should view the utility sector as a whole.
I completely agree.
It is no longer a story of stagnant, dividend-clipping infrastructure companies managing the slow decline of legacy assets. The utility sector has been forced to evolve rapidly.
Yeah.
They are actively architecting, engineering, and financing the physical grid that will dictate the pace of the global AI economy.
Which brings me to a final provocative thought for you to chew on as you review your portfolio allocations this week.
Lay it on us.
Look around the broader equities market right now. The herd is absolutely obsessed with buying the tech companies designing the AI microchips.
Right.
They are throwing capital at the software companies writing the large language models. The valuations for those pure play tech stocks are pushed to the absolute stratosphere, priced for utter perfection. But what if that entire sector is sprinting headlong toward a physical cliff?
The chips and the algorithms are useless without the electrons.
Exactly. If the physical capacity of the United States power grid is the ultimate immovable bottleneck for artificial intelligence, if you literally cannot turn the servers on without companies like FirstEnergy navigating the CPCN process, building the baseload power plants, and stringing the high-voltage transmission lines first, then a massive reassessment of value is required.
Makes you wonder.
Are traditional, heavily regulated utilities actually the smartest, most reliable, and most fundamentally mispriced AI investments available on the market today?
You know, it's the oldest axiom in investing. During a gold rush, you don't bet on the gold miners. You invest in the companies selling the picks, the shovels, and the pickaxes.
Right.
But in this case, we are applying that historical logic to the most capital-intensive, advanced technological arms race in the history of the world.
Think about that weathered wooden utility pole we started with, the rusty staples and the humming gray transformer.
Yeah.
It might look like a relic of the past, but the mechanics of the market dictate that it might just be the most critical infrastructure holding up the future of the global economy.
Incredible way to look at it.
Thank you so much for joining us on this incredibly deep dive into FirstEnergy's Q2 2026 earnings call. Keep digging into the SEC filings, keep analyzing the mechanical drivers behind the numbers, and we will see you on the next deep dive.